Thank you very much for everyone for making the time to join us this afternoon. The first in the Institute of Corporate Directors webinar series. My name is Nadia. I am your moderator for today. We are living in very interesting times. I think that is something we can all agree is the case. We are all in various stages of staying in place or movement control orders, or in fact, living through circuit breakers. These are trying times for us, and we do our part in the fight against COVID-19 by, of course, working from home. But this does not mean we cannot continue our duties, and in fact, in times like this is when we should. I would like to thank the Institute of Corporate Directors for hosting these sessions. There'll be more to come. Our first speaker is Shai Ganu, who is the ICDM faculty and MD, Group Leader, Executive Compensation and Governance, Willis Towers Watson. Topic for today is actually stakeholder primacy, increased emphasis on ESG, environmental, social, and governance. Now, in recent times, there has been this shift away from serving just your shareholders to all your stakeholders, whether that be your shareholders themselves, your customers, your employees, and everyone in your supply chain. COVID-19 has brought the idea of human capital and ESG issues to the forefront. More still needs to be done though. We will actually today discuss key ESG metrics and how they can be integrated into a company's culture. Before we start, just a quick reminder again, our chat function's on the side for you to ask any technical questions or give our feedback, but there's also a tab specifically for Q&A, and that one is where you can drop your questions. We will answer them at the end. Thank you very much for your participation. I hand it over to Shai to start.
I believe I'm now unmuted. Excellent, thank you. Thank you, Nadia. And again, good afternoon, ladies and gentlemen. Thank you very much for making time to attend this webinar. At the risk of repeating what Nadia shared earlier on, kudos to ICDM for launching this series of webinars. For those of you who I've had a chance of meeting before, I'm an ICDM faculty. My name is Shai Ganu, but as you probably will tell by the end of this hour that I'm not really shy. We are going to spend about 40-45 minutes going through some of the slides that we prepared talking about the subject, but we'll have ample time to go through question and answers. So throughout the course of this presentation, if you have any questions, please feel free to type those through in the chat functionality. The very lovely ICDM staff will be moderating some of those questions, and Nadia and I can get some chance to respond to them at the end of the session. But again, at the risk of repeating what Nadia was sharing, sessions like these are very important. In my professional capacity, I look after Willis Towers Watson's executive compensation and governance practice globally. I'm based in Singapore, so I'm dealing with the circuit breaker issues that were just announced. But more than that, in sort of a personal capacity, I serve on boards, both for profits and not for profits as well. And continuing director education and board of director upskilling is a subject that's very passionate and very close to my heart. So kudos to ICDM for launching these series of webinars. I know I'm going to dial in for the remaining webinars this week and next week. And hopefully through these 6 or 7 different topics under the 4 buckets that ICM shared up earlier, directors will get some useful insights and inputs about not just dealing with COVID-19, but also how do we act as responsible stewards for all our organizations. All right, so without further ado, I'm a consultant, so I don't leave house without slides, and I have about 100 slides to go through. No, I'm kidding, of course, but we'll get straight to the materials. What do we want to focus on today? So with the theme of stakeholder primacy and increased emphasis on ESG, what we wanted to cover today is 5 broad buckets. COVID-19 and its impact on stakeholder engagement. We will tackle the subject of stakeholder primacy. We'll do a deep dive into understanding ESG basics. So ESG, for those of you who are not familiar, stands for environmental, social, governance. So ESG basics. Then 4th, we'll look at a bucket which is ESG and human capital management, and specifically what can the board do there. And finally, some guiding principles to navigate through this crisis. The key objective through all of this is what we at Willis Towers Watson, we're calling stakeholder capitalism in the times of crisis. How boards should respond to COVID-19 by focusing on all stakeholders, shareholders, customers, supply chain partners, and employees. and equally, if some constituents not more important than the others. So with that said, let's first start with COVID-19, and this is something that I feel very passionate about. Uh, let's make let's have no illusions that COVID-19 is first and foremost a human capital crisis. Yes, there will be implications on societies. Yes, there will be implication on economies. There are recession concerns. There's couple of $1 trillion bailouts globally. There are shelter-in-place arrangements. There are working from home experiments. It's revolutionizing how people will work and nature of work itself. But first and foremost, this is a human capital event. And this crisis is underpinning the importance of leadership of all stakeholders. It underscores the criticality of leadership of and care for people and all the risks associated with people. It is also bringing it very upfront the importance of people in the economic equation. Um, Traditionally, companies have treated their financial capital or their intellectual capital, or in some cases, their physical capital, plant, machinery, goods, etc. They've treated those far more rigor than they have human capital. And I guess what this crisis has emphasized, it's that the importance of treating human capital um, with the focus of well-being of all employees, customers, supply chain partners. Now, what is human capital, you may ask? I mean, human capital is essentially a nice sounding business term for people, for human beings. Employees, co-workers, friends, partners. Our customers are part of human capital, suppliers, owners, communities. We're all in this together. So now, more than ever, is a time to reflect on what is important to you and your organization. What are you communicating to employees, customers, suppliers, owners, and communities? And that's what we're trying to understand the interconnection of all these different stakeholders. So with that picture painted about COVID-19, I did want to share then a view about stakeholder, or rather shareholder versus stakeholder primacy. And this is an issue that's come onto the forefront in the last few months. It's always been prevalent, but it's become more of a discussion topic in the past year or so. In August 2019, the Business Roundtable in the US released a statement on the purpose of a corporation. It was signed by 181 very prominent CEOs who committed to leading their companies for the benefit of all stakeholders: customers, employees, suppliers, community, environment, everybody. And this is a dramatic change from the Business Roundtable's decade-long stance that corporations' sole purpose is to serve the interests of shareholders. For those of us who studied economics, there was a very clear view that the purpose of the organization is maximizing profits and ensuring the interests of shareholders. And that notion is being tested and challenged increasingly. Institutional investors, and I'll share more examples later on, but large, prominent institutional investors, sovereign wealth funds, pension funds are demanding that the companies they invest in pay more attention to environmental, social, and governance issues, what we will refer to as ESG from this point on. And the increased focus on this topic of human capital, which forms a large component of the S within the ESG, so linked to the social aspect. Especially given the COVID-19 crisis, there's actually some discussion and some claim that 2020 will be the year of the yes. And what that does, it acknowledges that employees as human capital are key stakeholders in the long-term success of a business. And it suggests that shareholder interests are aligned with having healthy, engaged, hardworking, and productive employees. And only when that equation balances, the equation between all the different constituents and stakeholders, will organizations and corporations thrive. Let's take this a little bit further, and these are all quotes about investors and management leading the conversation. And a lot of this has happened in the last couple of years. The picture on your right, that's the three of the Business Roundtable CEOs. There's Jamie Dimon, of course, from JP Morgan, but there's also Alex, who's the CEO of Johnson & Johnson, and Ginny, who's the CEO of IBM. And these are only representative of the 181 CEOs. But essentially, these companies were saying that profits and purpose, business can have it both ways. And some of these quotes sort of stood out for us. Number one, without a sense of purpose, no company can achieve its full potential. And if it doesn't achieve its full potential and doesn't have a sense of purpose, it will provide subpar returns to investors. Larry Fink, who's the CEO of BlackRock, said this in 2018. Larry Fink actually sends a letter. So BlackRock is one of the world's largest, if not the world's largest investment management firm. Each year, they send the CEO, Larry Fink, sends a letter to all the investee companies in which he and BlackRock outline their expectations from their investee companies. I'll share more details about BlackRock later on because their sheer prominence on the stakeholder and stewardship debate is staggering, just given their assets under management. So I'll share more details about BlackRock in a couple of slides. But the second statement here I thought was extremely powerful, that profits are in no way inconsistent with purpose. In fact, profits and purpose are inextricably linked. Then we get into some of the other discussions about the purpose of a corporation. And I think the Business Roundtable listed this well, that in addition to sort of shareholders, what is important is delivering value to customers, investing in our employees, dealing fairly and ethically with our suppliers, supporting the communities in which we work, and generating long-term value for shareholders. And these 5 bullet points that you see in your left of the screen, those are equally, if not more pronounced now in COVID-19 than they have ever been. We've seen several cases of companies, several examples of companies who are taking more compassionate grounds towards their suppliers, who are taking more compassionate grounds towards their customers, especially the small to medium enterprises for whom cash flow management becomes critical to their survival. We know of several cases where companies are actually taking more of a compassionate ground to help everybody navigate through this crisis. And the 2 quotes at the bottom, again, Business Roundtable, and then one by Tricia Griffith, who's the president and CEO of Progressive Corporation. CEOs work to generate profits and return value to shareholders, but the best run companies do more. They put customer first and invest in their employees and communities. In the end, it's the most promising way to build long-term value. And to us, that sort of summarizes the key theme that we're trying to get out of this. Having painted that picture, and in the interest of time, we'll just move on to the core content that we want to cover today, which is understanding, number one, understanding ESG basics. And I'll share with you some material, some research around ESG. Number 2, impact of ESG on management incentives and KPIs. And why we're talking about that is essentially, there is this old adage that what gets measured gets done. There is another adage, is what gets paid for or what gets rewarded gets measured. So the best way, and one very effective tool that boards have to effect positive change, is through management incentives and KPIs. And I'll share some research that Willis Towers Watson did globally about prevalence of ESG measures in management incentives and KPIs. And then finally, we'll talk about the role of boards in ESG and human capital management. Okay, so without further ado, just deep diving into ESG. I touched upon earlier, what is ESG? Environmental, social, governance, environmental issues connected to responsible use of natural resources, global warming, energy usage, pollution, and the likes. Social factors such as how a company treats its workers, health and safety considerations, and community outreach. And governance, a focus on topics including business ethics, board structure and independence, executive compensation, policies around accounting practices. And if you think about all of these, they add to the intangible assets of an organization. And this study on the right-hand side that we've quoted, intangible assets as a percentage of market value have increased from 17% in 1975 to 84% in 2015. And this was the intangible market value study that was done in 2017. But it does place an emphasis on how important the intangibles around ESG are in the valuation of a company. There are several examples, and one of my clients actually, their business model is to only source and procure ethically sourced raw materials. They're in the food agro business, and the ethically sourced commodities and materials, they're able to charge a premium to their clients because their clients are also willing to pay premium for anything that's ethically and sustainably sourced. So business models are evolving where you have this alignment of sustainability interests between investors, consumers, and the talent creates this attention and new market imperatives amongst board and business leaders for the connection between human capital management practices, sustainable financial performance, environmental issues, etc. I think this heightened focus on ESG criteria with a subset of HCM, what we call in human capital management, will be a key part of any board's social or sustainability strategy. I'll share more details later on, but just to reiterate the point about companies with strong ESG profiles actually generate long-term value by increasing returns and reducing risk. So if you think about sort of the continuum from left to right, stronger ESG priorities lead to being more competitive, more profitable, higher returns, longer term value creation. It leads to better risk management, lower risk of severe incident, lower tail risk, lower systemic risk, lower cost of capital, higher valuations. And again, this is sort of the foundations of ESG investing that was based from MSCI ESG research. So it is a very compelling argument that focusing on ESG actually leads to long-term business value creation. But just to share this a bit further, companies that focus on ESG achieve more desirable business outcomes than those who don't. And at Willis Towers Watson, we've compiled different studies, including our own study. So Morningstar found that 2/3 of ESG and socially responsible investments, or SRI equity funds, edged their way into the top half of fund performance for the 2018 calendar year. Sustainable investing now represents a 30 trillion industry globally. 93% companies are more likely to report significantly outperforming the industry peers, according to research that we've done with high-performing companies. And purpose-driven companies outperform the market by 42%. So Willis Towers Watson, we do a lot of research around employee engagement, and we have a specific criteria that is called high-performing companies. And companies who meet the high-performing criteria, including their employee engagement scores, they tend to outperform their peers quite significantly. So the case for ESG is well made. And as I mentioned earlier on, BlackRock. So this gentleman, the picture here is Larry Fink, probably one of the most influential people in asset management, in finance, in business stewardship globally. For a few years now, every year he writes a letter to his investee companies. And I've tried to include some excerpts of this year's letter that he sent to companies, so sourced from the 2020 letter to shareholders. He talks about climate change as becoming a defining factor in companies' long-term prospects. Awareness is rapidly changing, and he believes that we're at the edge of fundamentally reshaping of finance. BlackRock has issued guidance, as have ISS and Glass Lewis, the proxy advisory firms, but BlackRock in particular says we will be increasingly disposed to vote against management and board directors when companies are not making sufficient progress on sustainability-related disclosures. A company cannot achieve long-term profits without embracing purpose. Purpose is the engine of long-term profitability. And I think this box on the bottom is significant, is profound. Because capital markets pull future risk forward, we will see changes in capital allocation more quickly than we see changes in the climate itself. In the near future, and sooner than most anticipate, there will be a significant reallocation of capital from one of the world's largest investment management houses to be saying this, that there will be a significant reallocation of capital. That is a very strong message. And already you're beginning to see companies take this mantle head on. There are several notable examples, companies coming out saying that they will not IPO any company. Goldman Sachs said this, that they will not help IPO any company if there is at least not one female director on the board. So purpose-driven, sustainability-driven, ESG-driven measures are definitely gaining in prominence. But putting this in perspective, what are the drivers for adoption of ESG practices? And beyond investors, there are a number of stakeholders that are contributing to this increased focus. You have, of course, employees. So employees of course, they would want respect at work, anti-bullying, preventing reputational risks, attraction and retention. There is a lot of research, again, that all things being equal, candidates would be more attracted to a company that stands for a social cause or that stands for a purpose. And in particular, in this part of the world, in Southeast Asia, we know of employees who would prefer to join companies that have a nation-building agenda. Because if you think about that, that is a big part of your purpose. Customers, brand value, reputation in the marketplace. Of course, it helps with the differentiation of your goods and services. If you have an ESG prominent proposition, regulators, and here practice would vary. But just to give you a perspective, in the UK, any company with more than 200 or 250 employees is required to disclose its gender pay gaps on a publicly available website. So this register, you can go in and search any company, and it will have to show you what is the statistics of how much all men are paid versus how much all women are paid. Now, interestingly, last week we also heard that given COVID-19, this requirement for the pay disclosures will be temporarily suspended for 2020, but we fully expect that to pick up in subsequent years. I mentioned earlier, proxy advisors are tightening their diversity policies and considering ESG scoring. Very recently, some of the proxy advisors have also come up with guidance on how they will vote on directors' appointment, directors' reappointment, director nomination based on the company's ESG policies. And board members need to be, our newer and more diverse members ask different questions. Boards are facing pressures to proactively address potential risks, and increasing disruption and pace of change requires companies to have a stronger emphasis, particularly on the G part in the ESG continuum when it comes to board members. And all of this, the underlying premise governing these changes is sustainability. So the ability to be maintained at a certain rate or level, and is seen from two perspectives. Number one, risk mitigation, fewer shocks of unsystemic risks. And second, long-term value creation, seeing long-term returns that outperform the broader market. And while we're sharing all of these proponents or all of these statements that make the case for stronger ESG, it is also our role to share the other side of the coin. So not everyone has embraced the importance of ESG. There is still an ongoing debate as to whether the main purpose of a company is shareholder primacy. So the left-hand side, the arrow pulling the debate to the left, which is the primary purpose of a corporation is to maximize shareholder value, and that corporation should not pursue strong ESG practices at the expense of profit maximization. So particularly in the US, there is a big group that is moving towards that left, pulling that debate to the left. And the right-hand side is what we've been talking about so far, the social purpose, which corporations need to consider other stakeholders, and that ESG adds value and reduces risk on long-term sustainable basis. I will share at the bottom that the Council of Institutional Investors, CII, disagreed with the Business Roundtable position as Business Roundtable's position of adopting ESG. So the CII actually says that ESG undercuts notions of managerial accountability to shareholders, and managers should only focus on maximizing profits and maximizing share prices and shareholder value. So this debate continues to rage in Anglo-Saxon boards. This part of the world, in Malaysia and Singapore, in Southeast Asia, the discussion is a little more balanced. But nonetheless, that tension still exists. So moving on, I did want to share some research around ESG as a tool for management KPIs and incentives. And at the onset, on slide 14, we're sharing some external perspectives of ESG measures. ESG metrics. And this is adopted from UN's, the United Nations Sustainable Development Goals, SDG framework. There are 17 goals, and different companies, all their actions sort of link back to these 17 goals. I've come across some very interesting annual reports and sustainability reports that talk about all the goals, which is very interesting, and how everything the company does, how it links back to one of these 17 goals, which is an important proposition. But specifically related to ESG, on slide 15, I wanted to share with you Willis Towers Watson's research. And so for those of you who don't know, Willis Towers Watson is probably the world's largest executive compensation and corporate governance practice. We have about 500 consultants specializing in board governance and board advisory work in 50 different countries. And some of this research is as a result of us looking at different ESG practices across companies. So this one in particular is the Standard & Poor's S&P 500 largest companies in the US, where we looked at the overall prevalence of ESG measures and how ESG measures are incorporated in incentive programs. So this is 2020 research, so very hot off the press. 51% of the S&P 500 companies incorporate ESG metrics in their incentive plans. 50% include ESG in their annual incentives, but only 4% include ESG in the long-term incentive plans. Long-term incentive plans, as most of you would know, those are incentive arrangements that have a 3 to 5 year time horizon, and they're intended to align management's interests with those of shareholders. Personally, this 4% number is a little low. We would expect, and over time, I suspect this will increase, where more companies are putting longer term incentives, may it be shares, stock options, phantom shares, whatever the case might be, linked to longer term ESG priorities. And there are some very notable examples. There are companies who've come out and said that their aspiration is to be carbon neutral by a certain year. Or in one particular case, a CEO came out and said that not only do they want to be carbon neutral, they actually want to repay the deficit of all their carbon offsets since the day of inception. And they're linking, of course, management KPIs, incentives, everything else to that. So it becomes a very powerful message. But if you look at this, about deep diving into this a bit, about how ESG metrics fit with incentive programs and design, what we also note is people and HR related KPIs are the most prominent, followed by customer service, diversity and inclusion, employee health and safety, governance, environmental and sustainability. But again, this tends to be a spectrum, right? ESG programs, although a slim majority measure and pay just using ESG, our research suggests that over 15% of the S&P 500 companies use hard quantifiable metrics to measure performance. ESG is applied subjectively in most companies. As an interest, integrating ESG among your incentive plans is something that is prompted by the Business Roundtable and institutional investors. And so we are seeing more and more companies putting more emphasis on disclosures, but also linking ESG into their management KPIs and systems. As you can tell here, there's a lot of emphasis on people measures. So I did want to spend a little bit of time talking about what would be some of these KPIs. And so these are some common KPIs, and this is a proposal that was released in February 2020 from the World Economic Forum. So the World Economic Forum released a thought paper called Towards Common Metrics and Consistent Reporting of Sustainable Value Creation. And it puts all the KPIs that it expects from management or from the company into 4 buckets. Principles of governance, planet, people, and prosperity. So it's not inconceivable, actually, if you think that the balanced scorecards of the future could look like these 4 quadrants. Currently, most management balance scorecards have financial, customer, people, and operational measures. It's not inconceivable to say that being replaced by prosperity, people, planet, and governance measures. But specifically looking at some of the people KPIs, and these are guidance by World Economic Forum. I'll share with you some of our research later on, but it talks about gender pay equality, diversity and inclusion, wage ratio versus the minimums, so current versus living wage, discrimination and harassment incidents, freedom of association and collective bargaining, risk of forces of child labor or forced or compulsory labor, workers' injury and absenteeism time, trainings for skills for the future. And this last one in particular is, again, something that we feel very passionate about. One of the biggest challenges that boards, management teams face now is not just, and as directors, it is our responsibility. It is not just how do we deal with the crisis of today, we also have to prepare our companies for the crisis for the future. And one big focus area has to be about upskilling and reskilling our employees. Because if not, sort of the business disruption, unemployment concerns, loss of jobs, that could have far long-lasting social impacts than we can imagine. The other bucket here is around planet, which is very interesting. It talks about climate change, nature loss, freshwater consumption, solid waste disposal, pollution indicators, etc. I won't go through all of this in detail, but maybe just in interest of time, because we did want to leave at least 10 or 15 minutes at the end for Q&A. Did want to spend some time talking about the role of the board. And let me start by this. So why should boards care about culture? You all would have heard this phrase that culture eats strategy for breakfast. Um, and I fundamentally agree with that. Culture does trump strategy, but only when there are some enablers. And the enablers are culture would sort of eat strategy for breakfast when companies have the data to start measuring it, when directors have seen the harm a culture can inflict on a company, may it be Me Too or mis-selling in the financial services, things such as selling credit cards to dead people, that was also culturally driven. When top tier culture goes a long way in attracting the best and the brightest, so when even the talent and candidates are drawn to a company because of its culture and what it stands for, and when culture fosters purpose and a stepping it up mentality, both by sustaining longer term gains as well as addressing the needs for the current and now. And so this is an important paradigm and what boards should care about it. I know the term culture gets spoken about a lot, but I just wanted to frame what we talk about culture. So culture is the foundational ways of thinking and behaving that shape the workplace environment through shared values, principles, beliefs, programs, and practices. And a simple way of thinking about culture is sort of your three tiers: your enablers, your behaviors, and mindset. Enablers sort of are your tangible programs. So from the bottom to the top, it's your tangible, visible items to the invisible, innate items. Enablers are tangible programs, policies, and practices which reflect culture. Behaviors are shared behaviors, standards, and experiences that are as a result of your enablers. And mindset becomes an underlying principles, values, beliefs, and assumptions which guide behavior together. And why this is important, because as we think about everything we've spoken about, um, I did want to highlight the role of the board in monitoring corporate culture. And this is important. And this is, again, Willis Stars Watson thought piece that was published in Director and Boards magazine, business publication in the US. And the title of the article was Purpose, Human Capital, and Profits, where we outlined out of our research that the role of the board in monitoring corporate culture is one of six items. So number one, employee engagement, ensuring that your employees are engaged. And there are different ways of measuring this, including Net Promoter Score or ENPS, Employee Net Promoter Score, or employee loyalty, turnover by level, experience level, etc. Second, leadership trust. And how you assess leadership trust could be through third-party trust indices that measure employee trust. One of the projects we did for a client here was to actually link the executive. One of the KPIs in the CEO scorecard was a reputation index that was sourced from third party about how much trust do not only employees, but customers and the overall society have in this particular CEO and management team. Number three, employee well-being. So components of physical, emotional, financial, and social well-being. Number four, looking at workplace inclusion and diversity. So diversity by level, pipeline inclusion, selection inclusion, etc. Workplace dignity. So employee completion rate of codes, harassment, policies, correlation between dignity and engagement, reported incidents, adverse media mentions, etc. And finally, human capital risk. So looking at lost time injury, frequency rate, productivity deterioration, incentives and behavior, sort of the whole bucket about human capital risk. And why this is important, because board members have reported in all the surveys that we do, and we are just about commencing a global research project where we will interview a few hundred non-executive directors and remuneration committee members under the auspices of the future of the compensation committee. So if any directors who are listening to this, if you're interested in sharing your views, we would love to talk to you about this and sort of get a chance to engage with you. But board members are increasingly reporting that a company culture has become a topic of great focus in recent years. Many organizations view board responsibility and oversight to, number one, setting the tone from the top. Number two, defining the company values that are acceptable behaviors, defining what is not acceptable. Number three, addressing areas related to inclusion and diversity. Number four, managing human capital risk. And number five, leadership trust and credibility. And increasingly, boards need to broaden their governance in areas such as employee well-being, purpose, dignity, sustainability, and have good data that can help them make informed decisions. And the business cases and business benefits of this are very needed. I mean, just to give you a sense, for example, we found that innovation is 6 times higher in companies where men and women are treated equally. Additionally, we found that employees, that companies which have companies who have high engagement scores are 93% more likely to report significantly outperforming peers in the same industry on financial measures. So again, we can go through a lot of these research, but the business benefits of doing this are well documented. I did also want to share what could be the different areas that the board focuses on when it's looking at human capital governance and particularly the S within ESG. And there are a lot of measures here. Each company will need to take a very bespoke and customized view about what makes sense for them. But the broad buckets would be, what is your labor profile? So diversity, employment mode, succession, your rewards, so gender pay ratios, fair pay ratios, inclusion, competitive programs, attraction and retention, so your turnover statistics, particularly turnover of high performers and high potentials, acceptance and time to fill rates, promotion rates, productivity, so training and development costs, labor cost performance, employee health and safety, well-being, and I've spoken about this earlier, but essentially well-being should follow all 4 parameters: financial, social, emotional, and physical well-being. And finally, culture, which includes alignment to strategy and purpose. And if you think about this frame, and if you think about COVID-19 right now, all any of us are doing, or all any board has been doing for the past month and a half, is focus on these measures, including well-being of employees, including social, emotional, physical well-being. Now, of course, there is a much bigger focus on boards, which is ensuring survival. So boards are also focusing on cash flow and sort of managing costs and trying to gear the company so that you can benefit from the uptick. But disproportionately large amount of time in the last few months has been spent on these issues. And our hypothesis is going forward, these will become more and more prominent. I'm conscious of time, so maybe just moving on, and wanted to summarize with a few call to action. Let me start by a couple of quotes, which summarize, I guess, the key sentiment here. And this is very relevant to COVID-19. So all of these are quotes that we've collated in the last few weeks. And so this one from Michelle Atkins, who's BlackRock's Global Head of Investment Stewardship, she says that the concept of long-term sustainability would suggest that companies that come through this crisis and do well would be exactly the kinds of companies you would look to as role models. That is a very powerful statement. And that companies can still demonstrate that they have effective leadership. In times of crisis, that becomes more apparent, not less apparent. And so this is a very strong call to action, not just to management, but also to board members about being or exemplifying role model leadership. This old adage about Winston Churchill being the right prime minister for wartime England, and after the war, you needed somebody else. During these times of crisis, the underlying sentiment that you would expect from management, it comes down to 2 or 3 broad buckets of qualities. Quality 1 is sort of almost a detached, calm demeanor. So no panic, no running around without a clear sense of direction. You want leaders to have very calm, deliberate decision making. Attribute two is something that is being called as contained optimism. So optimism about the future, being positive about the future and the future prospects. But most importantly, number three is compassion. Compassion, respect, not just for your shareholders or your employees, but for the entire ecosystem, for communities, for families, for all the stakeholders in the ESG equation. I'll share one more, and this is, I think, a very important one as well. This is from Sacha Satan, who's the Director, Investment Stewardship and Legal and General Investment Management. For those of you who don't know, Legal and General is the UK's largest passive investor. So it's the largest investor in terms of assets under management. It sent a letter, and I borrowed this line from the letter, which says, and to me, this summarizes the key shift in the thinking. It says, whilst in normal operating times, you being the board, so whilst in normal operating times, you ably balance managing your shareholders and all other stakeholders. During these challenging times, we encourage you, the board, to focus on all your stakeholders. And I think that is a very subtle yet important difference. Saying in normal times, you are trying to balance shareholders on one side and everybody else on the other side. But during these challenging times, you're balancing everybody at once. There is no trying to safeguard shareholders' interests at the interests of others. It's a subtle yet important nuance. And with that said, maybe just summarizing, and this was again taken from the World Economic Forum's white paper on workforce principles for the COVID-19 pandemic, stakeholder capitalism in the time of crisis. So Willis Towers Watson, I, and a few of my colleagues contributed to this white paper. It was the World Economic Forum prepared this white paper in collaboration with Willis Towers Watson. And there are 5 key principles that I'm leaving you with for boards, for management, the workforce principles for dealing with the COVID-19 pandemic. Number 1, understand this as a defining leadership moment to continue delivering the best possible outcomes for all stakeholders. Staying true to your purpose, values, principles, and culture, and embracing new ways of working. Number 2, adopting an agile and continuous learning mindset. One that harnesses innovation and creativity that arises in difficult times. Number 3, involve and engage all stakeholders in your decision making. Shareholders, employees, customers, supply chain partners, union works councils, healthcare providers, community, everybody. Number 4, focus on the intersection of the employee and the company well-being. Only when the two thrive, when everybody's successful. And finally, number 5, and I can't stress this enough, balance the immediate needs with the ability to quickly bounce back and remain viable in the long term. Particularly on this point 5, I mean, the COVID-19 pandemic has fundamentally changed the ability for people to work normally, for companies to operate efficiently, effectively, and for markets to function. The pandemic has shown the material value of the health and contributions of people to a company's business success. While companies in different geographies are impacted at different times and in different ways, there is a common set of characteristics and effective responses that we've seen emerge. So these are the ones that sort of we've tried to summarize in these 5 buckets, but particularly related to the 5th one, as companies are managing the crisis, there are 3 distinct phases that we would expect from leaders. Phase 1 or A would be managing the immediate needs of the crisis. So initial reaction and adaptation in key areas, working from home arrangements, cash flow imperatives, securing contracts, employee safety, etc., business continuity plans. Number 2, then in a few months' time, we need to start thinking about transitioning back to work. And interestingly, that is already happening in China. I should have added that slide, but I have a wonderful slide about China, particularly Shanghai, pictures in February versus pictures in April, beginning of April, and you'll see sort of businesses, societies, communities returning back to normal, and with resetting and reimagining operations under this transitioning back to work. What should be the protocols, focus areas, and the pace of resetting? And then finally, the third bucket, which is operating in the future state. So once we've dealt with the immediate crisis, we've transitioned back to work. How can we resume sustainable operations and redefine the new normal going forward? And with that, this is my last slide, which is again a very powerful quote that sort of reiterates the call to action or the need of the hour. That crisis forces commonality of purpose on one another. In this time of crisis, we all have to work together. We all have to emerge through this crisis as people. Crisis is underlining the importance of leadership of all the stakeholders in the organization. And this commonality of purpose hopefully will make us better, stronger organizations, employees, societies in the future. We've covered around 45 minutes of the content. So this is pretty much the material that I have. We have about 10 or 15 minutes to go through Q&A.
Yes, we do. Thank you very much, Shai, for that. Sorry to interrupt you. It's the lag in the thing, but thank you so much.
No worries.
Think for your insights. And I think it is very telling at this point in time, especially since, and I think this, and I heard this earlier today, I think all eyes are definitely on management, because in the US, for example, we can say that all eyes are a lot on the governors of the states and how they're managing their individual crisis. And essentially they are the managers for their states, right? And people are looking at them with this expectation of what's going to happen if you maybe step up to a higher plate. So I think a lot of people are measuring them on these metrics, and that's what we should be measuring our board metrics on for now. Before we go into the questions, just a quick one that I wanted to ask is that we've seen a lot of measures from a lot of companies. They're not all the same. They're not all standard. What do you think is a positive, what do you think that companies have done right? And what do you think some measures are, are perhaps not very useful, but what is it that companies have done in this crisis that you think are the right thing to do?
Yeah, thanks, Nadia. That's a really important question. And going back to this earlier theme about what companies have done well, it is that very deliberate leadership focus on navigating a crisis. And what do I mean by that is, I think a defining moment in any leadership team is how soon and how decisively are they reacting to and tackling some of these issues head on. So when we compare organizations, even in the same industry, even in the same geography, the more progressive ones realized the crisis for what it could be very early in their sort of journeys. They set up crisis centers and nerve centers to deal with crisis, to look at how the different constituents would all fit in together. They made some very decisive decisions quickly. But one of the defining attributes with all of this, particularly the more progressive companies, was how they looked at their employees and their supply chain partners. We've had several examples of CEOs coming out and actually saying that there will be no furloughs, or people will not be laid off, or we will not cut costs till the end of the year. Again, that was to reassure communities, to reassure sort of the employees that we're all in this crisis together. And if we have to take a short-term hit on our profits, so be it. But that is a better way of managing this crisis on the long term. The examples are quite a few examples in this, actually, particularly some of the Silicon Valley companies. They actually went the step in the reverse direction. Rather than worrying about cost cutting, they actually started announcing programs that would help employees in these tough times. So, for example, one of the FANG companies actually said that all employees received $1,000 bonus and sort of were guaranteed a minimum level of performance expectation for the first half year. And again, the intent was to ease the burden that employees would feel as human beings with their families, with their healthcare costs, with sort of the basic living needs. And so to answer your question, what are companies doing well? The more progressive companies are really looking at this in the three phases. Phase one is managing the current crisis. Managing the current crisis, ensuring business continuity, ensuring your employees are taken care of, ensuring your supply chain partners are taken care of. But then second, also having a nerve center and a think tank to start working towards transitioning back to work. How do we make most of working from home arrangements? What risks do we have? What opportunities do we have? And number three, how do you start working towards a new normal? Because it would be a shame that after all of this is over, if we go back to doing the same things that we did pre-crisis, then sort of a pivotal learning moment will be lost on all of us. It's about redefining how things are done, placing more emphasis on sustainability, more emphasis on balancing different stakeholders' perspectives. Does that answer your question?
Yeah, that definitely does. I think it is very pertinent to think about. We're going to questions from our many participants. The first one that we have is Grace Yap, and she asks, how would a company, almost related to what I asked, how would a company balance satisfying ESG preferences versus COVID-19's economic impact, the need to downsize, because profits are down? What are the best practices? And somebody followed up saying that 80% of Malaysians are SMEs. I worry about this too. What is the world going to look like, after this is all over? And just before you answer, just one more thing to relate it. You do also see a lot of corporates now taking, the head honchos taking pay cuts. AirAsia is one of them that I remember. Is that going to, how is that as a trend? What's your insights? But first, how do you balance, profit, survivability, and your people?
Very good. Thank you. So maybe I'll answer the last part about CEOs and boards taking pay cuts, because that will be a good segue into the rest of the conversation. So first of all, I think those pay cuts, particularly the ones that you see in the large organizations, put aside AirAsia, put aside aviation. Aviation, I think, is a separate kettle of fish that I'll get to in a minute. But the large organizations, these pay cuts that boards, CEOs, management teams are taking, they are more to signal solidarity rather than as cost cutting. Right? If you think about it, if a company has market caps of few billions of dollars, not your SMEs, sort of a few $100,000 here and there of executive pay is less about cost cutting. It's about showing solidarity. And that cost cutting, if it saves 1 or 2 or 10 jobs, then it's worth it. Right? So again, to answer the earlier premise about what is good practice of how companies are managing this, particularly with regards to downsizing and managing costs and headcount pressures. So good practice would actually suggest that organizations, companies have a hierarchy of different interventions from most preferred to least preferred. Unequivocally, let me state that least preferred would be cutting headcount. Right? Least preferred is cutting headcount. It's irrevocable. It's not socially responsible because the people that you let go, sort of, they don't have other livelihood to take care of themselves. So that is the least preferred, but still it is possible that some companies would be desperate that they would need to do that. But the hierarchy would start something like this. It would start with, first of all, canceling any discretionary spend. So things such as travel and entertainment budgets, or I hate to say this, but this is a reality, training budgets. I'm saying I hate to say this because times of these are actually the best times where you should spend in investing in upskilling and reskilling your population or your employees. But you go sort of with that level, cutting discretionary costs, eliminating leave liabilities. So asking people to consume all their unpaid leave, consume all their allocated leave, even taking leave for 2020. And then you get into some more drastic measures such as 4-day work weeks or voluntary pay cuts or forced pay. And even after you go through this, it is still possible that this is not enough. And when that happens, sort of companies will have no recourse but to look at headcount rationalization. our counsel and what I've been recommending to my clients is, rather than lay people off, if it comes to this or there's no other recourse, ask them to go on no paid leave so that you don't have the liability. But if things pick up again, you're allowed to sort of bring them back into the workforce as quickly as possible. Also, in the time that you're doing this, and Singapore Airlines is an example, this is public domain. In the times that you're doing this, if you are asking people to go on unpaid leave, uh, allow them to take on a second job, right? So it will require modifications of your employment contracts. Most of our employment contracts prohibit us from working from more than one job. But if you're forcing somebody to go on unpaid leave, allow them to take a second job. Now, look, I fully appreciate this doesn't answer the question of SMEs. And to be honest, the SMEs who are cash flow strapped, the answer has to be through government interventions in times like this. Subsidies, stimulus packages, the US doing the 2.2 trillion package, Singapore announcing, I think this morning or today announcing a new set of measures. So it will require government intervention to ease cash flow issues. I particularly liked the US sort of stimulus. The number looks big, 2.2 trillion, but they're not printing $2.2 trillion. Around $1 trillion out of that, let's say about half of that, is related to loans and loan payments for existing companies. So either in critical industries or small to medium enterprises, even Malaysia, Singapore, governments in this part of the world should think about how do we actually support the SMEs, because the SMEs are the backbone of the economy.
All right. Oh, that's very, very, I was hoping it wouldn't just be stimulus, but obviously that's the way it actually has to go. We have a question from Jeffrey Ng. He's saying that how should a company articulate its efforts and achievements in navigating the current crisis, so that, I assume it means because some of these decisions are going to be very tough. He asks, how do you do it in a way that will get greater acceptance and maybe recognition by the stakeholders, in a way saying that this is what we have to do in uncertain times, communicate that it's the best for them.
Yeah. So some of this is going to sound like obvious things, but there is power behind this. I think in these uncertain times, first and foremost, particularly when you're managing different stakeholders, is having that shared sense of purpose and also a shared understanding of the crisis. Organizations who've done this well, including some of my SME clients, they've been very upfront with their stakeholders, different stakeholders, employees, customers, their banks, their debtors, about their financial viability, about if things don't change, how much runway do they have, and sort of what are the risks that they won't survive. This one particular case, and this is not public domain, so I won't share the name of the company, but this one particular case when the CEO actually shared everything with the employees, and it's not a small organization, it has a couple of thousand employees. He shared the situation with employees, being very upfront, saying, look, this is a crisis. Unless XYZ happens, we will not survive. Employees actually came back to him and said, we are willing to go 4 days, get paid for 4 days a week, but we'll work for 5 days. Right? So it banded everybody together through this common sense of purpose, this common purpose of beating the crisis. Now, no company is in a position to make promises, right? But there would be still a gentleman's agreement, or a gentleperson's agreement, I should say, that if we see through this crisis, then people will be made whole for whatever they're giving up. So if you're giving up something now, 6 months' time, if things pick up, because particularly industries that have been the hardest hit, aviation, hospitality, food and beverage, those are the industries that would see the immediate uptick when the social distancing protocols end, right? The minute or as soon as this ends, airlines will be full again, hotels will be popular, sort of other industries may take a little longer for the supply chains to be reinstated. But particularly travel and aviation sort of will pick up very quickly. So the view is now, if we do this right, we all bandy together. And to answer the question, the best way of getting engagement from stakeholders is authenticity. Authenticity about your crisis, but authenticity about the purpose and how all of us collectively will overcome this together.
There is this question here, I think, that asks something that's very tough. And, talking about balance, Esther Yap actually asked that it's estimated that 30% of the existing companies will not make it. Others will struggle to survive. profitability wins above all, even above sustainability. How is this any time to have resources to focus on ESG?
That's a great question, Esther. And to be honest, the question actually implies that these are an either or choice, as in either survive or focus on ESG. I think our entire proposition is it's an and proposition, that survive to focus on ESG, or it has to be combined. And if you take us within the ESG, environmental, social governance bucket, if you just for now during the crisis focus on the S, so focus on the human capital bucket for now, because again, in thinking about Maslow's hierarchy of needs, sort of what is immediate now is the focus on ensuring the right thing by our employees, ensuring the right thing by our supply chain partners. Doing that should not come at the cost of profits or revenue or financial viability. The hypothesis is that should actually be inextricably linked to your financial health. Asking for examples like asking for longer lines of credit from your suppliers, or asking for your customers to make partial payments to manage your cash flow, asking employees to defer part of their pay. There were some other questions about executive pay cuts, asking your executives to donate or cut salaries so that you don't have furloughs and you don't have layoffs. All of these are geared to actually balancing this as a continuum rather than as and or.
All right. We have time for basically just one more question before we sadly wrap up for this afternoon. There's a question from An talking about what is the role of the independent directors in ESG's handling? What's the best practice to balance major shareholders' interests against the interests of all stakeholders, linking it to the role specifically of the independent directors? Basically, how will they handle it aside from like the board, their role? How does their role become richer?
Yeah. So I think the role of the independent director has always been that of a steward, right? And I've said this, ICDM has said this, and we've said this in prior sessions. The role of any independent director is one of three. Number one, ensuring regulatory compliance. Number two, driving company performance. And number three, future-proofing the organization. Most independent directors in business as usual will focus on number one, which is ensuring regulatory conformance. Your compliance checklists, your audit controls, your books are in account, et cetera, et cetera. During times of crisis is more than ever that we have to focus on number two and three. Ensuring company performance, so company performance coming out of the crisis, but also gearing up to participate in the uptick, and future-proofing the company. I mentioned this earlier on that it's a personal sort of pet peeve that when times are tough, people cut training budgets. Actually, when times are tough and people are working from home is the best time to invest on training and training and upskilling, because if you have the resources, of course, because when you are back in business as usual, you have a fully engaged, productive and upskilled workforce who's willing to tackle problems differently. So the future proofing of that organization, that becomes a critical part for directors. But very tactically, and I know some of this was philosophical, but very tactically what independent directors can do about ensuring ESG performance is the monitoring and tracking of ESG measures. Having dashboards, asking your management the right questions, looking at questions such as your environmental KPIs. So independent directors, we often become often are held ransom or often make decisions only based on the information that management provides. The role of a good independent director is to ask the questions that are not included in the management presentation. So your financial forecasts, your 5-year business plans, what is the environmental impact? What is the social impact? What is the people impact? So asking those questions and getting the right information and monitoring and tracking that information sort of would be the three big buckets.
All right, with that, thank you very much, Shai, for your insights this afternoon. I apologize greatly that we weren't able to get through a lot of the questions, but for all our attendees, you can leave them in the chat box. Shai will look at the questions and we will respond if possible. With that, thank you so much Shai, for your insights this afternoon and the Q&A. I know this is very unusual times. I've said that several times, but it does bear repeating. But thank you very much again, and we hope to hear from you soon. Just a quick shout out to all the attendees. We would definitely like to hear from you. Please use the survey link that you see in the chat box or scan the QR code to provide your feedback and topics of interest on the webinar. Please be gentle, it is our first time. ICDM will be rolling out our online program series soon, so please watch this space for more details. If you are very, very interested, please register your interest with development at icdm.com.my or visit icdm.com.my. Thank you very much again. The second, actually, in our ICDM webinar series will take place tomorrow, same time, same place. Our speaker then will be M. Nazir Mohammed, and his topic will be Review Competitive Strategies Using AI, a Board's Perspective. See you at the next webinar, everyone. Please be safe, protect you and your loved ones. Stay home. Thank you very much.
Thank you all. Stay safe and healthy.
Thank you.
Ik hoef dus outside. Ik was